Well, for most people, Christmas comes just once per year, but for those in the value investing community, generally each year towards the end of February or even into early March, we get the annual letter from Warren Buffett, which for many people is kind of like Christmas coming a second time in 12 months. And in this year's letter, Warren Buffett shared a lot of great wisdom, much of which he has written and spoken about before, but there were a lot of lessons in this letter that are certainly worth revisiting. Now, the full letter is about 10 pages long. I won't go through all of it in this video. If you want to check it out and read it for yourself, which I highly recommend doing, I will leave the Berkshire Hathaway website linked down in the description below so that you can check it out. But in this video, I want to go through some of my own highlights from reading the 2023 Warren Buffett letter for the year 2022. So if you enjoyed the video and haven't subscribed to the channel already, please be sure to do so. But without further ado, let's get straight into some of these highlights from the latest Warren Buffett letter to Berkshire Hathaway shareholders. Now, one of the common criticisms of Warren Buffett, if you can make any at all, is that he is sometimes a little repetitive and can share the same lessons over and over again. And that was one of the common criticisms out of this year's letter, is that there wasn't really a whole lot of new stuff. But I think that in a lot of ways is kind of the point with what Warren Buffett does. On the very first page of the letter here, you'll see Warren Buffett's track record in terms of stock returns from 1965 when he took over control of Berkshire Hathaway through to 2022. And the strategy that he's employed and the lessons he's communicated over the years to Berkshire Hathaway shareholders and just investors in general interested in learning about becoming better investors have been incredibly consistent. And that same strategy has been used year after year and decade after decade to build incredible results for shareholders. We have to keep in mind that pretty much every single year at this point, the audience for these letters gets larger and larger. If you go back and read like the 1950s letters from the Buffett partnerships, it was to a relatively small number of partners who tended to be slightly more sophisticated investors. Even through the 70s and 80s, Buffett was getting into some detail with investment lessons on specific bets or acquisitions that Berkshire had made in the previous 12 months or in the past couple of years. And although Buffett has tended to get a little further away from specific investment examples over time, he tries to share general lessons that the everyday investor can employ in their investing and to try and help, maybe newer shareholders in Berkshire Hathaway get their heads around exactly what Warren Buffett is doing. So let's simply start this one out by looking at the scorecard for Buffett, because this is really the reason why he's considered one of, if not the greatest investor of all time. From 1965 through to 2022, Berkshire Hathaway shares have returned a compounded 19.8% per year for a total gain of 3,787,464%. Now, there are a relatively small group of investors who probably have better returns than Buffett in terms of their annual return, higher than the 19.8%. If you get above, say, 15% or certainly above 20% for a consistent period of time, you really are in very elite kind of company with investors generating those returns. But there's basically no one, at least that I'm aware of, that has been able to generate those kinds of returns for such a long time. And having that high rate of compounding for such a long time does pretty incredible things for shareholders. That 3,800,000% return is enough to turn $1 invested into $37,000 over that entire time frame that Buffett's been at the helm, or about $10,000 would have turned into about $378.7 million. And like Buffett has spoken about many times, the returns back in the early days will be much larger than probably what will be achieved moving forward. The sheer scale at Berkshire and the amount of capital they're now working with really does limit their investable universe, and it will lower the returns moving forward. So certainly don't expect 19.8% per year out into the future. But nonetheless, the track record is just out of this world. Now, Buffett really starts out this letter by highlighting basically what he does and who he works for, or at least how he thinks about that. He says, Charlie Munger, my longtime partner, and I have the job of managing the savings of a great number of individuals. It is those dedicated savers that are forefront in my mind as I write this letter. We believe Berkshire's individual holders largely to be of the once a saver, always a saver variety. Though these people live well, they eventually dispense most of their funds to philanthropic organizations. Who wouldn't enjoy working for shareholders like ours? This is definitely a big area where Berkshire Hathaway differs from the typical large American corporation. They are really focused on individual shareholders, which Berkshire has a quite large concentration of in their kind of overall shareholding of the company. They're less focused on large institutional investors, and they have a very unusually low kind of percentage of investors buying and selling out every single year. Most people that own Berkshire Hathaway tend to view it as a long-term savings vehicle, a place where they kind of trust Buffett to manage their money and generate good returns over a long period of time, and they're not really people looking for a quick pop in the stock price or anything like that. Again, I think with a bit of a focus towards newer investors this year, Buffett reiterates the couple of things that he basically does day to day at Berkshire. He says, first, we invest in businesses that we control, usually buying 100% of each. Berkshire directs capital allocation at their subsidiaries and selects the CEOs who make day-to-day operating decisions. Disappointments are inevitable. We are understanding about business mistakes. Our tolerance for personal misconduct is zero. In the second category of ownership, we buy publicly traded stocks through which we passively own pieces of businesses. Holding these investments, we have no say in management. Our goal in both forms of ownership is to make meaningful investments in businesses with both long-lasting favorable economic characteristics and trustworthy managers. Charlie and I are not stock pickers, we are business pickers. A lesson reiterated here again on the public stock side is that one advantage of our publicly traded segment is that episodically, it becomes easy to buy pieces of wonderful businesses at wonderful prices. It's crucial to understand that stocks often trade at truly foolish prices, both high and low. Quote, efficient markets exist only in textbooks. Controlled businesses are a different breed. They sometimes command ridiculously higher prices than justified, but are almost never available at bargain valuations. Unless under duress, the owner of a controlled business gives no thought to selling at a panic-type valuation. Now, I think one of the main lessons Buffett tries to get across in this year's letter to Berkshire shareholders is that the vast majority of the stellar record at Berkshire can really be attributed to quite a small number of investment decisions that he and Charlie Munger have made over the years. He says, most of my capital allocation decisions have been no better than so-so. Our satisfactory results have been the product of about a dozen truly good decisions. That would be about one every 5 years, and a sometimes forgotten advantage that favors long-term investors such as Berkshire. Let's take a peek behind the curtain. So on that topic, Buffett goes on to share two public stocks that he invested in a very long time ago, that he's held for a very long time, and that he's had quite good results from. The first one is Coca-Cola. This is arguably Buffett's best known investment ever, I would suspect. He says in August 1994, yes 1994, Berkshire completed its 7-year purchase of the 400 million shares of Coca-Cola we own. The total cost was about $1.3 billion, then a very meaningful sum at Berkshire. The cash dividend we received from Coke in 1994 was $75 million. By 2022, the dividend had increased to $704 million. Growth occurred every year, just as certain as birthdays. All Charlie and I were required to do was to cash Coke's quarterly dividend checks. We expect those checks are highly likely to grow. He also shares a similar story with American Express, saying that American Express is much the same story. Berkshire's purchases of Amex were essentially completed in 1995 and coincidentally also cost $1.3 billion. Annual dividends received from this investment have grown from $41 million to $302 million. Those checks too seem highly likely to increase. These dividend gains, though pleasing, are far from spectacular, but they bring with them important gains in stock prices. At year end, our Coke investment was valued at $25 billion, while Amex was recorded at $22 billion. Each holding now accounts for roughly 5% of Berkshire's net worth, akin to its weighting long ago. He then goes on to explain how if he'd just invested in a 30-year bond, kind of how poor the results might have been and how much value that those couple of bets have really added to Berkshire over time. And he says the lesson for investors, the weeds wither away in significance as the flowers bloom. Over time, it takes just a few winners to work wonders, and yes, it helps to start early and live into your 90s as well. And it certainly is worth saying here that the Coca-Cola investment, although spectacular and a great result over a long period of time, certainly had its returns concentrated in kind of the first part of Berkshire's holding of Coke stock. From 1994 through to, say, 2000, Coke stock really exploded. The dividend growth, like Buffett said, has been steady for a long time, but a lot of the capital gain came in those really early days, and the returns from, say, 2000 to 2022 have been not actually that great for Buffett. The capital gains were so great in those early years that even over that long period of time, the results are still pretty satisfactory, and that dividend yield on his initial investment is enormous. But the Coke investment probably is a bit of a tale of two periods of time, and it's one of those examples where Buffett was probably handicapped a bit by his size. It took him a long time to buy into Coca-Cola, and he really didn't have the ability to sell out at Coca-Cola in 2000 when the stock price was very high. He owned so much of the business that he really just chose to hang on rather than try and get out and likely push the stock price way down, although even in hindsight, perhaps that might have been a good decision. Buffett shared a few comments on Berkshire's underlying operating earnings for the past 12 months, but also the past several years, and he reminded investors in Berkshire that it's important to focus on this non-generally accepted accounting principle that he shares of operating earnings. There was an accounting change a couple of years ago that forced Berkshire to include unrealized changes in the value of their stock portfolio in their income statement each quarter, which can make their net income swing around very wildly. So Buffett argues that even though capital gains will be very important to Berkshire over a long period of time, the market fluctuations in the short term are really meaningless in terms of looking at Berkshire's underlying operating earnings of the businesses that they own outright. He says that the company's operating earnings set a record at $30.8 billion using that kind of non-GAAP figure and excluding their equity holdings. And this is what that looked like, quarter to quarter, those underlying operating earnings, versus if they were forced to include the fluctuations in the stock portfolio as well. And you can see that those stock market fluctuations have an enormous impact on the reported net income for Berkshire. So focusing on that sort of normalized operating earnings is definitely the way to go. He touches a little bit on float, which of course is the cash generated from a lot of their insurance businesses. Basically, a customer will pay an insurance premium, Berkshire will hold on to this money for a little while, which Buffett calls float. Some customers will then make an insurance claim, and that money will be kind of paid back out. And over time, that money kind of sitting in limbo as float has grown a lot, and it's been available actually for Berkshire to invest. And it's effectively like a very low cost way of borrowing money, and it has certainly juiced the equity returns for Berkshire over time. And he explains that the recent acquisition of Allegheny that Berkshire made last year has helped to increase the float even more at Berkshire. Buffett says, aided by Allegheny, our insurance float increased during 2022 from $147 billion to $164 billion. With disciplined underwriting, these funds have a decent chance of being cost-free over time. Since purchasing our first property casualty insurer in 1967, Berkshire's float has increased 8,000-fold through acquisitions, operations, and innovations. Though not recognized in our financial statements, this float has been an extraordinary asset for Berkshire. Buffett does touch on one topic that he believes has kind of been unjustifiably controversial in recent times, which is share buybacks. He goes on to explain that the math isn't complicated. When the share count goes down, your interest in our many businesses goes up. Every small bit helps if repurchases are made at value accretive prices. Just as surely, when a company overpays for repurchases, the continuing shareholders lose. At such times, gains flow only from the selling shareholders and to the friendly but expensive investment banker who recommends the foolish prices. Gains from value accretive repurchases, it should be emphasized, benefit all owners in every respect. Imagine, if you will, 3 fully informed shareholders of a local auto dealership, one of whom manages the business. Imagine further that one of the passive owners wishes to sell his interest back to the company at a price attractive to the 2 continuing shareholders. When completed, has the transaction harmed anyone? Is the manager somehow favored over the continuing passive owners? shareholders, and has the public been hurt? When you are told that all repurchases are harmful to shareholders or to the country, or particularly beneficial to CEOs, you are listening to either an economic illiterate or a silver-tongued demagogue, characters that are not mutually exclusive. And the final thing in terms of Berkshire's business that Buffett touched on, another one that is sometimes controversial for corporations, is around corporate tax and how much of a contributor to corporate tax Berkshire have actually been over time. He says, during the decade ending in 2021, the US Treasury received about $32.3 trillion in taxes, while it spent $43.9 trillion. The $32 trillion of revenue was garnered by the Treasury through individual income taxes of 48%, Social Security and related receipts 34.5%, corporate income tax payments 8.5%, and a wide variety of lesser levies. Berkshire's contribution via the corporate income tax was $32 billion during the decade, almost exactly 0.1% of all the money that the Treasury collected. And I have done the maths there on a little bit, so if you focus just on the corporate tax components that the US Treasury collected over that decade, Berkshire has paid about 1.2% of all corporate taxes in the entire decade, so the amount of money that they're sending to the government in taxes each year is kind of mind-boggling. Buffett goes on to say, and that means, brace yourself, had there been roughly 1,000 taxpayers in the US matching Berkshire's payments, no other business nor any of the country's 131 million households would have needed to pay any taxes to the federal government, not a dime. Just to try and put that amount of money in context, Buffett asks readers of the letter to imagine freshly printed $100 bills just stacking vertically, and he says, finally, imagine piling up $32 billion, the total of Berkshire's 2012 to 2021 federal income tax payments. Now the stack grows to more than 21 miles in height, about 3 times the level at which commercial aeroplanes usually cruise. When it comes to federal taxes, individuals who own Berkshire can unequivocally state, I gave it the office. Now, from time to time in these letters, Buffett does enjoy doing a little bit of reminiscing of the very old days, original days of Berkshire Hathaway, and kind of taking us through to where Berkshire is today. And in 1965, Berkshire was a one-trick pony, the owner of a venerable but doomed New England textile mill. And then came a stroke of good luck. National indemnity became available in 1967, and we shifted our resources toward insurance and other non-textile operations. Thus began our journey to 2023. Berkshire now enjoys major ownership in an unmatched collection of huge and diversified businesses. Let's look at the 5,000 or so publicly held companies that trade daily on the NASDAQ, the New York Stock Exchange, and related venues. Within this group is housed the members of the S&P 500 Index, an elite collection of large and well-known American companies. In aggregate, the 500 earned $1.8 trillion in 2021. I don't have the final results for 2022. Using, therefore, the 2021 figures, only 128 of the 500, including Berkshire itself, earned $3 billion or more. Indeed, 23 lost money. At year-end, Berkshire was the largest owner of 8 of these giants: American Express, Bank of America, Chevron, Coca-Cola, HP Inc., Moody's, Occidental Petroleum, and Paramount Global. In addition to these 8 investees, Berkshire owns 100% of Burlington Northern Santa Fe and 92% of Berkshire Hathaway Energy, each with earnings that exceed the $3 billion mark noted above, $5.9 billion for BNSF and $4.3 billion for Berkshire Hathaway Energy. Were these companies publicly traded, they would replace 2 present members of the 500. All told, our 10 controlled and non-controlled behemoths leave Berkshire more broadly aligned with the country's economic future than is the case at any other US company. He goes on to say that as for the future, Berkshire will always hold a boatload of cash and US Treasury bills, along with a wide array of businesses. At Berkshire, there will be no finish line. Now, a couple of last things from this letter before we wrap the video up. Firstly, there was a section in here which was a little bit of a tribute to Buffett's partner, Charlie Munger, who is 99 years old as of the time of this letter coming out. He explains that Munger was recently in a podcast. I don't know that he actually was. I think Buffett might be referring here to the Daily Journal Corporation annual meeting that Charlie Munger was recently in. But if I've missed something and he really was in a podcast, please let me know in the comments below. And he shares quite a few quotes from Charlie Munger. And then he goes on to talk a little bit about the annual meeting coming up this year and some of the success that See's Candy had at last year's annual meeting. Now, I won't go through every quote that Buffett shared here of Munger's, but I'll pick out maybe a couple of my favorites. And again, if you want to read the full letter, definitely go and check that out. So a couple of my favorites here that Buffett shared of things Charlie Munger has said is patience can be learned. Having a long attention span and the ability to concentrate on one thing for a long time is a huge advantage. Next, don't bail away in a sinking boat if you can swim to one that is seaworthy. A great company keeps working for you after you are not. A mediocre company won't do that. There's no such thing as a 100% sure thing when investing, thus the use of leverage is dangerous. A string of wonderful numbers times 0 will always equal 0. Don't count on getting rich twice. You don't, however, need to own a lot of things in order to get rich. And finally, here's one that Buffett added, Warren, think more about it. You're smart and I'm right. And a bit of advice from Warren following that sort of tribute section to Charlie. He said, I'll add to Charlie's list a rule of my own. Find a very smart, high-grade partner, preferably slightly older than you, and then listen very carefully to what he says. Now, very last thing, just to wrap this letter up, is an interesting fact that came out of See's Candy from last year's annual meeting, and I want to bring it up because I feel like I may have contributed about ballpark $10 or $15 to this stat. But he's talking about some of the sales that See's Candy's generated at the annual meeting in Omaha last year. He says, in short order, our See's kiosk sold you 11 tons of nourishing peanut brittle and chocolates. On Friday, the doors were open from noon until 5 p.m, and our candies counter rang up 2,690 individual sales. On Saturday, See's registered an additional 3931 transactions between 7 a.m. and 4:30 p.m, despite the fact that 6.5 of the 9.5 operating hours occurred while our movie and the Q&A session were limiting commercial traffic. Do the math. See's rang up about 10 sales per minute during its prime operating time, racking up $400,309 of volume during the 2 days, with all the goods purchased at a single location selling products that haven't materially altered in 101 years. What worked for See's in the days of Henry Ford's Model T works now. So firstly, pretty crazy just to see that amount of money spent on like chocolate and peanut brittle at the annual meeting, but very cool to also see a product that's lasted so long that has really been a hallmark in Berkshire's like acquisition history over the years. I think they learned a lot from the success of that acquisition and paying up for a good business, and it's just amazing to see how durable the business really has been as well. So there you have it. Those are some of my highlights from Warren Buffett's 2022 letter to shareholders that comes out here in early 2023. I do hope you enjoyed it. Let me know some of your own highlights down in the comment section below. If there's anything you enjoyed from the letter that I didn't cover here, be keen to hear that as well. And if you haven't read the letter yet, again, it is linked down in the description below. But that's it from me for this one, and I'll see you in the next video. Cheers.